Welcome. This is our webinar series on next generation M&A. My name is Adam Sanyago, the founder of ModalMinds, and I'll be moderating. And with us is Jonathan Bunce, M&A principal for ModalMinds. Really what we wanted to have Jonathan do, based on his experience of $5 billion of transactions under his belt, 20 years of transformational success in large enterprises, is to share with us his expertise around and his perspective around what's going on with M&A today. What can we do to really make an impact and break the traditional cycle and start to change the equation around to have more often than not better success and positive returns. So kicking off with really a view and understanding of the M&A landscape, it just seems like the overall statistic of 70% failure continues to be the average. So what can we do to really change that? So Jonathan, I know you keep running into this statistic. What's the situation out there?
So the situation is like you well articulated. It remains about 70-75% failure rate, which is horrific, and we all know that, and every CEO knows that, and every corporate development team knows that going in. Now we live in exciting times. The applications for antitrust laws is up about 300%, which means there's going to be a lot of acquisition activity, which is driven by the times we're in with mobile, social, and the cloud. So there's a lot of infrastructure, there's a lot of new software and services, so there's a lot of consolidation, there's a lot of new developments, and time to market is driving M&A activity. However, the numbers still stay the same. It's about 70% failure rate. And I think the reason, if we look at it in kind of at a high level, why is that? That's a question we want to answer. It's still focused on the deal jockey. It's still at the corporate development to get the deal done, and they're compensated for, and they do a great job. And they negotiate a good valuation up front, which is their objective. But that's not the right focus on M&A, and that's why the failure is happening. We'll get into details on that. So it's really, it's like I said, it's centered around the financials, the valuations, the market analytics,
Sure.
and then legal. Legal comes in because they have to mitigate risk, and so they do their analysis. Yeah. And then day one happens all of a sudden.
Right.
So there's really no maybe strategic due diligence to the depth that they needed to, or executionable analytics done, and understand the people and the teams that have to carry out the integration of the two companies. And so the deal dynamics are still skewed, and it's still kind of on historical models.
Well, so it sounds like this definitely isn't a financial problem. Financial, there's a component, but before it was considered really the only path to get a deal done. But of course, now you look at the whole integration life cycle and achieving those value drivers, and now maybe that focus has kind of led you astray. While it's required, it sounds like there's some missing parts.
Absolutely. It's an ingredient that doesn't go away. It's very critical. We need the investment bankers. We need the corporate dev on the valuation from the financial standpoint and legal. I think what we're looking at is, though, there's a skill set defeasance is what we like to say in there. And there's not we see a lacking of a holistic business understanding. And where do people get that skill set? Because typically corp dev has come from the investment banking side. And so they're astute in that, it's kind of boxed into financials. And really, the deal is all about the business. So that's the complexities of every function that's involved in there. So there is a little bit more human capital that needs to be analyzed. Change management. People are not aware of how much change is going on, the complexities of that, and the psychology behind all that too, and the drivers of that. So we have some models that we'll be looking at that address that.
What about the deal transition? I mean, so we talked about how the financial guys, we like to call them the deal jockeys, they put together the package, and then all of a sudden signature happens, and then we're in day one. What gets lost there? I know that's a hard point of contention with you.
Yeah, that's what we like to call the chasm.
Okay.
The first chasm. We have two major chasms, but that's the main chasm. It's that immediate, abrupt handoff. Because a lot of times these deals, especially if it's public companies, they're kind of under the radar. Corp devs working, with legal, and many other factions of the company won't even be aware of the acquisition that's forthcoming. And so all of a sudden, like you said, everything's done, the valuation is agreed on, everybody signs the papers, they're happy, they celebrate in the bar, and then day one happens. But now the rest of the employees, the troops of both entities, are now challenged with implementing it's a marriage now. There's two companies that
Good.
now become one, which we call the new co. And it's analogous to a marriage. I always bring it to a marriage. It's a husband and wife, and whatever their upbringing has been. Now they come together, they create their new doctrines and ideologies of the family, the unit of the family, and then they'll have their offspring, and how do they groom them. So it's the same thing with a company coming together, two companies coming together.
Interesting. So based on that knowledge, you would think that some of the experienced practitioners like yourself, but I mean other folks that have probably been in the business much longer than us, they still keep falling into the same traps, missing these. What's stopping that from happening, and what can we do? And I guess we'll talk about what we can do to start to close those gaps in a kind of a lean fashion. But I mean, it sounds like the people are missing everything you're talking about.
Yes, Adam, and I think what it is, it comes down to the skill sets. It's a different skill set that gets involved with corporate development and the investment side, and that's more the ingredients that come on. It's more executionable skill sets, which is holistic business understanding, cross-functional integrations, a lot more detail on those complexities, which really the corp dev don't dive into. That's not their forte. Not to say neither should it be, but they don't really get involved in the post execution. They're typically the remuneration packages for corp dev is once day one comes, they've achieved their goals and objectives and roles, responsibilities, and they're off playing golf now. They're done. I think the new generation going forward is going to say that they need to be more involved now all the way through, probably 2 years through. That's really when you're going to see the roots of a successful acquisition and integration come through, and where the business objectives are going to play out or not play out.
Yeah, for sure, because the business case and the value drivers are still relevant, and frankly, the life cycle of the integration is important for capturing a lot of those values, not just setting up the good deal, right? So the life cycle of the integration plays a huge role in ultimately executing. What can we do differently outside of enhancing the handoff? Is there a different way to manage integration? Is it leveraging some of the same components then augmenting them? What's your approach as you look kind of post close as you go into the integration side of the house, since that's such a larger footprint?
Yeah, post close is really looking more at it's kind of a three-legged stool. You have the market analytics, you have the financial analytics, and the missing stool leg is really the executionable, and that's what you need to monitor all the way through. Mm-hmm. And that's looking at the leadership competencies. It's looking at goal alignment. Are all the goals in line for the business objectives of the acquisition from the very beginning, pre-deal, and then the team continuity. The people that are on the team, because many times we'll see practitioners come in and they do a 6-month project after day one, and then they close the IMO, and they think it's done. Yep. And really, that's just when things get launching. And so that's the other kind of chasm, is that it gets thrown into project management, which is very critical, once again, a key ingredient, but that's not going to deem you the success or failure of the acquisition. And there's a lot more complexities that we look at.
So I think what I hear you sort of laying the foundation for is really almost applying another lens to how you look at the integration. It sounds like the moving parts are still the same, but maybe kind of having an irrational 100-day or 180-day line in the sand doesn't make sense. But it's really about looking at it kind of as an organism, and part of execution has to be supported by how people perform, as well as kind of how strategies align. Is that correct?
Yes, correct.
Okay, so it sounds like that's a good segue to think about really you elaborating in our next part of the series about how you view the anatomy of a proper integration, and maybe not creating a bunch of overhead, but thinking about a different lens or overlay so you can practically think about how to really manage that next generation integration.